I'm joined today by Charlie Hill, Global Equity Senior Portfolio Manager at Mondrian Investment Partners. Charlie is among the incredible investors sharing insights at the Equities Investment Forum today. Welcome, Charlie. It's great to have you with us.
Thank you. It's great to be here.
Charlie, can you describe Mondrian's approach to finding value in equity markets?
Yeah, so Mondrian's a value-oriented defensive manager. The cornerstone of our investment process is our dividend discount methodology. And the key here is isolating long-term value in the flow of cash dividends that we as investors will be receiving. Value for us is far more than simply cheap metrics. There are plenty of reasons why a company trading on a cheap PE or cheap price to book might not be an interesting opportunity. They might be very highly levered, so they'll struggle in a downturn. There might be risks that are facing the company or the industry, or they might simply not be growing. So that's where our fundamental research process comes in. We do use screening to look for ideas initially, but once we find ideas that might be interesting, that's when we do our detailed bottom-up work. So starting at a segment level, we build up to integrated financial statements, income statement, balance sheet, and cash flow statement. And importantly, when we get to the cash flow statement and free cash flow, we're then looking at how that cash flow is being used. So for example, companies might be highly levered and we will pay down that debt. Companies might be acquisitive, and so we'll use some of the cash for M&A. And then we can start to think about, again, buybacks and dividends so that the returns to shareholders. So really, it's a long-term approach. We build our portfolios as teams, so it's a team-based approach. And again, it's long-term. We're forecasting out 10 years into the future. We have long holding periods, which average 3 to 5 years, but can be a lot longer than that. So a long-term approach, a team-based approach, and very much focused on fundamental research.
How do you avoid the increased volatility that is often associated with value equities management?
Yeah, so the defensive nature of our portfolios means that we tend to preserve capital during downturns. And what does that mean? It means that when we see increased volatility in markets, we tend to be less volatile than both the index and most of our peers. And that helps to reduce the volatility in returns for our investors. So the first point to say is that the dividend discount approach that I talked about a moment ago is part of this, because dividends are an inherently less volatile element of equity returns. But the second and perhaps more important point is that we look not just at a base case when we're analyzing companies, but also at a worst and a best case. And with particular emphasis on the worst case, it helps us to avoid some of the riskiest companies, which might be have the greatest chance of permanent loss of equity capital. So we do find examples of companies where the base case might actually be quite attractive, but the worst case is really quite concerning. Again, going back to what I was saying previously, that could be because they have a very highly levered balance sheet, or it could be because there's significant risk. So we want to avoid those types of companies. And what that means is that it comes through in certain characteristics, so lower volatility than the index. And you can see that through standard deviation. So with standard deviation over various rolling time periods going back sort of to inception, you can see that our standard deviation is meaningfully lower than both the index and than peers. And it's obviously not all about reduced volatility. So we also are very much focused on returns, and the solid returns that we have earned over the last 35 years since inception, but also over the last 10 to 15 years, mean that we have a strong Sharpe ratio and rank in the top 15% over the last 10 years compared to our peers.
How do you build and manage your equity portfolios to deliver consistent characteristics?
Yeah, so one of the remarkable things for me about Mondrian is the consistency of characteristics over time. And I think I can hopefully say that as someone who's been there only the last 10 years or so out of Mondrian's 35-year history. But I think the consistency of these characteristics across time and different portfolios is quite impressive. How's that done? Certainly the stability of teams helps. So the average tenure in the global equity portfolio or strategy committee is 15 years and higher than that amongst senior members. But inevitably, over a 35-year track record, there is evolution within a team. So I think really the key is the consistency of the application of our philosophy and process. And one way we look at that is through what we call our bull-bear chart. This is a chart that's in many of our materials and available on our website as well. Within the chart, we break history down into a couple of different sections. So we look at bull markets, a bull market being any quarter where the index is in positive territory, a bear markets being whenever the index is in negative territory. And then we look at the longer term performance. So going back to the inception of the global equity product, within bull markets, as across all of Mondrian products, we aim to capture the vast majority of that upside of a bull market. But then within bear markets, we aim to capture less than 80% of the downside. And by reducing this volatility in a downturn, it gives us a stronger base from which to grow when markets turn and start to recover. Over the long term, about 2/3 of quarters are bull markets and 1/3 bear markets. We've seen slightly fewer bear markets in recent years, but it's that sort of quantum. And actually, since inception in bull markets, we've captured around 90% of upside and around 65% of the downside. So that comes through in longer term outperformance by, again, preserving capital during the downturns and then growing from that base as things recover. And I think what's remarkable to me is not just the fact that these characteristics have been maintained over time within one product over those 35 years, but also that these characteristics are maintained across all products at Mondrian. So if we look at the international product, the emerging markets product, the US equity product, they all have remarkably similar characteristics of capital preservation during downturns, capturing most of the upside in strong markets, and then that coming through in long-term outperformance.
How do you deal with differences between equity markets and sectors? And are there areas you completely avoid?
Sure. So to take the second part of that question first, there are no areas that we completely avoid. We're able to look across the universe. Now, the characteristics we've touched on for Mondrian's portfolios, and you can expect them to be the same. So valuation focused, value focused, defensive in downturns. On that basis, there may always be parts of the market, particularly at the sort of very high growth end, that you wouldn't expect to see in Mondrian's portfolios. But we can certainly look across the full universe, and we think that's important for building diversified portfolios. So we believe that the dividend discount model is the most effective way of doing this. As I mentioned earlier, we build long-term models from segments up to integrated financial statements, income statement, balance sheet, and cash flow statement. And when we get to cash flow statement and free cash flow, we're then thinking about what a company's going to be doing with that free cash flow. So do they need to pay down debt? Do they need to carry out M&A to be able to maintain their growth? And are they returning cash through share buybacks and dividends? What's important for us is our long-term approach. And therefore, the dividends that are ultimately received by shareholders are really what we're discounting to today's value. But I would point to share buybacks. So buybacks have obviously been a significant part of the shareholder return component for within the US, and much more so perhaps than in the rest of the world. Now, buybacks don't obviously return cash directly to all shareholders, but by reducing the number of shares in issuance, it means that dividends paid over the longer term will be increased. The dividend per share is increased because of the lower number of shares. So because we are looking at the dividends returned over a very long-term time series, it means that we can discount when those dividends come through to today's value. It is worth pointing out that we are able to hold and do hold names that don't currently pay a dividend, providing we can see that they earn sufficient cash and will have the willingness to pay a dividend at some stage in the future. Even if we have no dividend in the first few years, when they do start being paid, we can again discount them to today's value. But it's worth reiterating that our dividend yield is higher, meaningfully higher than the index, always will be, and also that the vast majority of our names do pay dividends, but that is across all sectors and markets within the universe.
What are the key attributes of Mondrian and its approach to equities investing that sets it apart from peers?
Yeah, so we've talked about the philosophy and process at Mondrian, which I think are key. I think there's a few things I point to on a company-wide basis. The first is the stability of the company. So 35 years of history as a firm. Within that, each of the products also have their own long histories and very long tenures of staff. So averaging 15 years within the global equity product, that would be similar across others. And again, that's even higher than that amongst senior investment professionals. Within Mondrian, all the global equity team are partners within the firm, as are the majority of investment staff in other teams as well. And that really leads to a sort of long-term approach from the team, but also a very focused approach and everyone pulling in the same direction, everyone pulling together. So I think that the stability of the company is key. The second I would point to is discipline. So that's discipline in terms of the depth of our research. We really get to know our companies well, their competitors, their suppliers, and really start to, from a standing start, really build up detailed knowledge. And as I've touched on, build out these very detailed models looking out long term into the future. And that long term approach is also comes down to our discipline. It's very easy in today's markets to be focused on next quarter or the next 12 months. We really do look out long term into the future, and we have long term holding periods as part of this, and it allows us to take advantage of time inefficiencies in markets, which we think is a persistent area of opportunity for us. The final point I would touch on is consistency. So it's the consistency of the application of our philosophy and process, but it's also the consistency of the characteristics that we achieve. So we've touched on the lower volatility and therefore the capital preservation during downturns, but also the characteristics that we are able to generate in terms of value characteristics of our portfolios, higher dividend yields, and the long-term outperformance that really comes through the consistency of the characteristics. So I think stability, discipline, and consistency are really what sets Mondrian apart.
Thank you, Charlie. We're going to need to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Equities Investment Forum.
Thank you for having me.